Hello, everyone. Well, I have a difficult one. You guys have been listening about options trading for 3 hours, and I still need a bit more of your energy after 3 hours of listening to options. So work with me on this, okay? I'll keep it a bit shorter in my case, even though I have a lot to share, okay? And I tend to speak fast, which means I need you fully focused, okay? Can I count on you, everyone? Thank you. Very good. So my name is Jose Blasco. We're going to talk about options, obviously, but we're going to focus on 2 specific type of options. We're going to focus on SPX options, and we will also focus on VIX. Okay, VIX options, okay? SPX options, VIX options. So we'll talk about this. Now, the objective for the webinar, for the seminar, sorry about that, it's to understand a bit more about the structured features of options trading. There are certain things that have been said already which are very important and absolutely critical. For example, the fact that there are expiration dates. The fact that it could be a call, or it could be a put, or it could be combinations. I like to say options give you options, okay? And it's so true. So we're going to dive a little deeper into those various structure possibilities within the context of SPX and VIX. And by the way, during the presentation, I'll stay on this side of the stage because I have a clicker that needs to be close to that computer so it works. So apologies over there, okay, but I'm with you too, okay, and I certainly want to interact with you all. And later we'll have questions, by the way. So, the goal, and I love earlier at the very beginning of the day when Isaac talked about being systematic. So the goal here not only is to learn a bit more about options and SPX and VIX, but also to open the door to creating processes that are systematic for weekly routines. Okay? In other words, you know, everybody has a different lifestyle, a different life, obligations, responsibilities. You may have a job, you may not have a job. You may have kids, you may not have kids. The fact is that all of you may be able to set up some sort of a routine where every day, 3 times a week, once a week, maybe over the weekend, whenever that is, you sit in front of your computer and you come up with a methodology that you apply and you implement and you trade and you take advantage of the markets in a way that is systematic. So you have consistent action, so you produce consistent results. Because if your action is random, unless you are very, very lucky, it's difficult for the results to be consistent. Make sense? So that the concept of being systematic goes in line with consistency. Consistent action, consistent results. Okay? So we're going to talk about this. We will also talk about VIX options from the angle of helping portfolios. In other words, and today we've done that already, there have been times during the presentation today where we've been talking about you buy a call, and trading a call is much better than trading the shares in certain context or environment and so on. We saw results like a 20% move paid you 120% or whatever the number was. It's very efficient. That approach, which is 100% valid, implies that you don't trade shares, you trade options instead, which is a very valid approach. Nothing wrong with that. But there is another approach that we have also been touching on a little bit today, which is you keep trading your shares, you may be used to it, you like your stocks, you have a portfolio already, and you want to do is add options to it as a combination, so you have shares and options combined to produce other benefits. In this case, we'll talk about portfolio protection, okay? So we're going to be discussing this in today's presentation. So a little bit of reframing options, SPX options applications, then we'll talk about the VIX ones. Very important that the whole time that I'll be talking about options, in my mind, number 1 level of priority is risk management, okay? So again, we'll go back to this idea of limited risk strategies, and we'll talk about this more in depth later in my presentation as well. It's in the panel, don't miss the panel we'll have a break after this, I believe. Later, we'll have a panel, don't miss that. We'll talk more about option spreads and limited risk strategies. It's super, super important, okay? Okay, so I'm struggling a little bit with the clicker if you see the screen is not moving, okay? So my name is Jose Blasco. I'll skip the slide, okay? We have limited time. This is about you, not about me. If you want to know more about me, come find me during the breaks, and I'll be happy to introduce myself. But anyway, so reframing options, right? So options are not just leverage bets, okay? Options, depending on which article you read on the internet or which YouTube video you watched, some people may use them as extremely speculative. They may even call them unlimited risk, right? And that's true. You could trade options in a way that is unlimited risk. But there are also ways on how to implement option strategies where risk is totally under control, like 100% under control. The simplest example is the example of buying a call, as we covered earlier, right? If you buy a call, you pay 2. What's the most you can lose? 2. Even if the underlying stock goes bankrupt all the way to 0. The most you can lose is what you paid, right? So that's limited risk. That's not desirable to lose everything you paid. But obviously, you pay 2 for an option for a stock that may be worth 20. Well, you only lost 2 instead of losing 20, right, in this example. So that's a limited risk approach, and we'll dive a little deeper into this. So we can define the outcomes before they happen, which is not necessarily the case with stock trading, okay? I'll give you an example. Let's say you buy a stock, $30 per share, to put a number, and let's say you learn risk management and you decide to have a stop loss. So if the stock goes against you, you're gonna be stopped out. So in your mind, you're like, okay, I bought the stock at 30, my stop is 29, the most I can lose is 1. Okay? Yeah, but what if the stock gaps, right? The US market trades 6.5 hours a day, which means it's closed most of the time. So many things happen during Asian and European sessions before the US reopens, and you may have a gap. Have you ever seen gaps? And sometimes they are large, isn't it? So when you have a stop loss, the stop loss will not protect you. Whereas with option strategies, if you buy a call and it costs you 2, the most you can lose is 2, no matter if there is a gap or not. So you have more control over risk, okay? Which is the most important thing that we traders do. It's all about risk management, actually, okay? There are different types of methodologies, and there are some that may be better than others, but in the end, no matter the methodology, without risk management, well, good luck, okay? So we need to control that risk. So on top of that, with options, we can combine options in different ways. So Kathleen was mentioning you can buy a call and sell a call against, right? For example, that's an example of what we call a call spread. Bull call spread could be one of those. So when you do these kind of things, you are constructing positions that may be more adapted to you, to your trading style, to how bullish you are, or are you bullish neutral, or are you only neutral? Or are you, not sure? You are non-directional. What are you trying to implement in the marketplace, right? So we can do all of those things with options, and it's very powerful, okay? Very good. So now that we have kind of pointed at some very important aspects of trading options, let's talk more about what do we mean by unlimited risk, okay? Again, unlimited risk means unlimited risk, okay? So we need to be very careful with taking unlimited risk, okay? But unlimited risk does not necessarily mean that you lose more than what you have. It depends on what you are doing. For example, if you buy a stock, right? The most you can lose is what you pay for the stock. Now, if you sell a put, or if you buy a trading book, 99% of trading books will tell you that selling a put is unlimited risk. If you buy a put, the worst case scenario is, number one, you get pay premium. That's not bad. Second, the stock gets put to you, so you are assigned. So now you own the shares. So you own the shares, that's the worst risk, but you get paid to own the shares. Correct? That is less risk than owning stocks. But options books will call that unlimited risk, okay? So we gotta be careful with some of the terminology that is available out there, because sometimes it makes us feel that, oh my God, options, that's complicated, that's sophisticated, that's dangerous. Well, it depends on what we are doing. If you're selling a put, right, and you instead of selling 1, your account maybe would be comfortable with 1, but you sell 20, well, actually, options are not risky. You are risky, right? So we gotta understand what we're having in our hands, no matter what we do in life, in trading, etc. Right? So very important. Again, today we are not gonna be, at least in my session, we are not gonna be talking about selling options. I'm going to be talking about buying options, okay? And buying options is, maybe more easier to understand, more intuitive. And again, when you buy something, you pay for it, and therefore the most you can lose is what you paid for, right? So it's limited risk by default. Anyway, so I'm just fast forwarding a little bit because we talked about this. So yeah, with options, the beauty as well is to implement, as I was saying, your market views, no matter what the views are. When trading stocks, typically you buy. So you need the stocks to go up to make money. If they go down, you suffer, unless you are short, which is doable, but not too common in stock trading. It's more common with futures. So with futures, you go long, you go short, you make money in both directions. But in both cases, long or short, you need the market to move. What if you are in front of a market which is going sideways or is moving up 2 and it's looking like it's going to the moon just to go down 2 or 3, looking like it's going to crash and go to 0 to just go back up 2 again, and it's kind of going nowhere and it's driving you crazy, right? So what can you do? Again, there are option strategies that we could implement. I'm going to show you an example in a moment with SPX options, where you can, in a very relaxed manner, be exposed to whatever the market does. And instead of focusing on where the market is going, listen carefully to this concept. I'm going to repeat this. Instead of focusing on where the market is going, you're going to be focusing on where the market is not likely going to go. So think about this concept. What's higher probability? For you to guess where the market is going, or for you to guess where the market is not likely going to go? What's more high probability? Number 1 or number 2? Number 2, right? Because let's say the market is trading here at 100, and you say, before the end of next week, it's unlikely we'll go below 80. That's a high probability. It depends on the stock, right? But that's a pretty high probability bet, if I was to use the word bet, right? Is a more safe market outlook instead of saying, well, if I buy now at 100, I think it's going to 120, but if I buy now at 100 and it drops to 99, I'm already losing money right now, right? It's a bit more of a greater level of exposure. So again, with options, they are very attractive because we can do all sorts of things, including trading non-directionally. And all of these that I'm saying applies to the daily intraday traders all the way to the long-term investors and anywhere else in between. Okay, so control is everything. We want to make sure that risk is under control. We need to plan for the trades. In the prior conversation with Alwyn, you guys got to see beautiful risk profile graphs on the screen where you saw, the red color, that's where your risk is, the green color, that's where you profit, and you can evaluate and measure everything. That's the beauty of options, okay? Graphs of this sort, okay, makes your life easy, okay? I think Kathleen was using the term having a peace of mind, isn't it? That's what it is. You know exactly what's going to happen. If you're wrong, which you will, which we are, all of us are wrong sometimes, you lose whatever amount is on the red zone. If you're right, which you will, which all of us are right sometimes, you will make what's on the green side. And that now you can evaluate and let the trade do itself because the markets, are going to do their thing no matter if you trade or you don't. So it doesn't make sense for us to stress out. Just put your trade where you have evaluated risk and reward and let the market do its thing. So with all of these concepts in mind, let's think about using SPX options. Okay, I'm going to start with SPX options. And now the scenario I'm going to paint here is a scenario where I am assuming, and I know this is not all of you, but I am assuming that you guys are active traders that want to have a systematic methodology that every day you put your trade on and then you go to sleep. Okay? And at the end, you wake up next day in the morning and you find out what happened. Okay? So that's what I'm thinking. Okay? Now, you can, instead of doing that every day, you can do that every month, you can do that every week, you name it, right? But I'm just going to go with every day. Since we have limited time, I'll start with intraday. So SPX options are based on the S&P 500 index. Okay? Largest equity index market in the world. It has all the sectors in the market, 500 stocks, huge, massive, super relevant, and basically trading that market is probably the one market you don't want to miss, right? It's the most important market worldwide. So this is a chart updated a few days ago of the S&P. Right now, it just bounced a little bit out of those green UFOs and went a little higher, as you saw with the real-time charts with Isaac earlier. But this is the S&P. You've seen this before. So with options, okay, with the S&P, since the S&P is the largest market in the world, the SPX options happen to be the most liquid options that exist. There are many stocks in the US market, let's say 9,000, rounding numbers. Around 6,000 got options. And maybe, let's call it 300 got some okay liquidity to trade options in the US market, okay? Now, that's stock options. What we are discussing here is not stock options, it's index options. So it's options on the S&P, and these are the most liquid of all. Huge, massive market, many expiration dates, many strikes, many of everything, tight bid-ask spreads, and very important, that market is cash-settled options. Cash-settled options means that you don't get delivery of anything. That's why I was saying you put the trade at the end of the day, you go to sleep. Because whatever happens is going to be cash settled in your account. When you wake up in the morning, if you were right, you have a profit in the account. If you were wrong, you have a loss in the account, which was pre-calculated before you did the trade. That's a very valid way. There are more ways to do it, but there are very valid way on how to trade options as a routine, as a systematic approach. So cash settlement means that even if you are assigned, you don't get shares put to you. You don't get to own any stock. The result of owning the stock, which is a profit or a loss, would be cash settled in your account, right? So it's very convenient from that point of view. So they are very well suited for systematic strategies, daily or weekly routines, massive, strongly institutional participation, and plenty of expiration dates. So if you look at the screenshot coming in on the screen, this is an option chain. And by the way, looking at an option chain is not nice, okay? It's not a beautiful picture. It's actually overwhelming, isn't it? Too many figures. It's confusing unless you are used to it. But the point of this slide is not to confuse you, is to tell you have many expiration dates. I know the font is very small, but on the top you can see many dates. So you have options that expire today and tomorrow and the day after and the day after and the day after every day. We call them 0 DTEs, 0 days to expiration, right? You have expiration dates every single day and you have many strikes, okay? Many strike prices, above price, below price, where price is, a little above, a little below, very much above, very much below, all over the place. You have a lot. So again, options give you options, right? SPX options, even more options. So we can do a lot of things which are convenient and intelligent for traders. So here is an idea that we can implement. I'm going to go for the next slide, which is going to be playing the intraday range. And again, we have very limited time, so I'm going to go through these slides a little fast, but for sure, you can ask the moomoo team to email you those slides. Feel free to take pictures with your phone and so on, and happy to share my contact information if you have questions later on, no problem, okay? But the point here is that every day, between the open and the close, the US market, will experience price movement. So instead of thinking where the market is going, I'm going to be exploiting the price range of the day, the daily price range. In other words, I only want to bet on where the market is not going above and where the market is not going below. And whatever is in between is going to be the price range where I expect the S&P to be. I don't care if it's above or below. I just want it to be in a range. That's what I'm going to exploit in this particular approach. So what I'm doing there is I'm using the orange lines on the left are pivot points. So pivot points, again, is a technical term. It's a mathematical calculation that has to do with a prior high and low and close and a collection of numbers that you calculate and you project those pivot points, which are the orange lines above and below. And then on the right, I'm using auto UFOs, which is a technology which identifies on-field orders. UFOs is on-field orders. And that allows me to know where is the buying and the selling in the market. So by knowing where are the UFOs and where are the pivot points, I can now draw on the right chart those two black horizontal lines. Those two black horizontal lines here represent the daily range. So the S&P is in the middle. You can see there is one candle, okay? Maybe I'll try to point at that one candle there. Okay, that one candle here. Let me go there so you can see as well. Okay, that one candle there, that is where the market opened the day of the screenshot. And now you have the black line above and the black line below, which basically represents the price range where you expected the S&P to be when it closes. You don't know if it's going to be above or below, in the middle, but somewhere in between, right? So what can you do? Well, you can now sell a bear call spread above and sell a bull put spread below. I know those are technical terms for options trading that may be a little confusing if you never heard bear call spread, bull put spread, which, by the way, when you do those two things together, it's called an iron condor. Okay? And again, it sounds fancy, but it's just very simple. Basically, what it is, you can see in orange colors here on the right, is that I am buying a call and selling a call above, and I am selling a put and buying a put below. That's what I'm doing. And then that will give me what we call credit. When I do all of this, these are, some of you earlier said that you have traded 4 options-like strategies earlier. This is 4 options-like strategy. So when you do this, by the way, you do it as one trade in your platform. Very easy to do. And the moment you get in filled on this trade, you collect a credit. Okay, you collect a credit. It's a net credit because you are an option seller, so you get paid premium. When you are an options buyer, you pay premium. When you are an options seller, you collect premium. With limited risk. You collect premium, and the most you can lose is limited. So now you can see here, after when the market closed, that the S&P went up, then it went down, and it closed somewhere in the middle of the range. So now those options expired, and the credit is cash settled in your account at the end of the day. Okay, so this is a very, very common, typical application of options trading, which I personally enjoy, and many other traders around the world, especially since SPX launched zero DTE options. It used to be that options traded only on the 3rd Friday of the month, once a month. That was the expiration date. Then they became weekly, so every Friday of the month you had the options. Then it became Monday and Wednesday and Friday, 3 days a week, and now it's every day. So it's amazing. You can make this as your routine, and it becomes very efficient. Now, this is a little bit of a, kind of a sneak peek into what we can do with SPX options. Of course, you can be directional. I show you something for intraday trading. You can do it for long-term investing if you'd like to. But now let's change topic, okay? Let's talk about the VIX options. Okay, let's talk about the VIX options. And before we talk about the VIX options, we need to talk about what is VIX. Okay? So, because VIX options will be options on the VIX. So the question is, what's the VIX? Okay, SPX options are options on the S&P. You know what's the S&P, right? But the VIX, I'm not sure we have it clear because I often see a lot of confusion. So let's talk about what is the VIX. Okay, I need to go back over there. So the VIX measures the expected 30-day volatility of the S&P. So I need to explain something very interesting about how options are priced. Earlier, we talked about options could be seen as insurance. Remember the car insurance example that you had earlier today? So think about options as insurance, but in this case, I want to think about house insurance. So let's say we are dealing with a house or a property that is worth $1 million. And that property is in Singapore. And now let's compare the insurance that we need to pay for that $1 million house in Singapore with a $1 million house in Florida in the US. Well, what's the difference? In Florida, there is risk for hurricane. So while the value of the property is the same, which insurance do you think will be more expensive? The one in Florida or the one in Singapore? In Florida, because there is more risk, right? That's what the VIX measures. The VIX measures how expensive options on the S&P are, okay, from the point of view of how much risk is built in. The higher the VIX, and I'm going to show you a chart of the VIX so you see that. Can you get me one slide backward? Thank you so much. So this is the VIX. At the time of the screenshot, it was like 24. Recently, the VIX reached around 28, and now it's down to like 16. So at the time of the screenshot, it was 24. So when you see 24, like in the screenshot, it means that when you look at the options prices, those options prices reveal the expectation for the future movement of the S&P. And the expectation for the future movement of the S&P is 24% a year. Up or down. It doesn't say up or down. You don't know if it's up or down, but the speed of movement, which is the risk, is expected to be 24% a year in 68% of the cases. That's a one standard deviation. I don't want to get too much into quant finance, but that's how the options pricing models work. So in other words, options become expensive when there is more risk. Options become cheaper when there is less risk. Well, if instead of options on anything else, we look at options on the S&P, and let's pretend you have a stock portfolio with US stocks, maybe some of the 7 magnificents, for example. So what would you think would happen to the VIX if the 7 magnificents or some of the stocks are going down in general? What would you think would happen to the VIX? It will go up. There will be more risk. So what is one very simple way to protect a portfolio of stocks is to buy calls on the VIX. That's a very simple way on how to protect a stock portfolio. So take a look. Let me come. I have a chart that I want to show. Here we go. This one. You can see the chart on the left. The S&P is a 4-hour. The SPX is a 4-hour chart, and you can see how it's going down. On the right, we have also a 4-hour chart, but it's the VIX. What is the VIX doing when the S&P is going down? It's going up. Is it all the time? No. But it's, let's call it 80% of the times. There is a very, very strong inverse correlation between the S&P and the VIX. So again, what can you do? Well, let's say next week is going to be, okay, first Friday of the month, every single month. 8:30 a.m. New York time, 9:30 p.m. Singapore time. You have the unemployment number being reported. Let's say you have a great concern for unemployment number in America. Or let's say, some Wednesday in the middle of the month, they will have a report about increasing or decreasing interest rates. And let's say you are very concerned about it. Well, you get in front of your moomoo app, you look for the option chain with VIX options, you identify the calls that you want to purchase, the expiration date, depending on your concern, and you can add some hedge ratio to your portfolio by buying calls on the VIX. Because if the market was to tank, VIX would go up. So you can make money on the VIX while you may be losing some money on your stocks. Correct? So you are hedging your stock portfolio, right? And let's say the news was very good and the market goes up and your stock portfolio is doing very well and the VIX went down instead of going up. Well, now whatever you pay for the VIX calls is lost. But if you paid 2 for the VIX calls, what is the most you can lose? 2. So while you lost 2, which is your insurance, okay, your portfolio is doing well. By the way, this is the same you do with insurance in life, right? So let's say you have a car and you are such a good driver, you have a car, you have car insurance, and you didn't have an accident in the whole year because you are a fantastic car driver. And now you go home and you blame yourself. I should have had an accident, so I get to use the insurance. Would you do that? No. So you'd be delighted to lose those $2 on the VIX calls because you bought them, you paid for that just in case the portfolio was to fall. Is that making sense? So again, very easy application, okay? So we're gonna have to wrap up here. But basically, SPX options provide directional and non-directional opportunities. VIX options help you reduce portfolio volatility during stress. You can buy VIX calls. You can have a combined use supporting opportunity and stability. So one of the angles of my conversation was creating a systematic weekly or daily approach to having your opportunities in place. The second angle of my approach was to hedge a portfolio of stocks that you already have. And this works for active traders or long-term investors. It's all about the expiration dates that you select when you trade options. The beauty of options is that options give you options. You have many expiration dates and many strikes to select, which basically depends on how do you want to trade. Anyway, I guess I'll have to say bye for now. I will see you again during the panel a little bit later. Thank you very much, everybody.
Thank you, Jose. Once again, a warm round of applause for Jose.